Big news came out today from the Federal Reserve. The chairman of the Federal Reserve, Jerome Powell, spoke on Thursday in a conference, stating that there will be strong job growth in the future. But as of now, the economy is nowhere near reaching full employment. These comments, along with the issue of surging bond yields, did not assure investors, causing the Dow, S&P 500, and Nasdaq to take a huge dip today. In this video, we'll be going over and analyzing what Powell's comments are and what they mean, and what this means for us as investors. So let's get started. Hello everyone, this is Chris with MC Stocks. Remember to subscribe and hit the like button for more videos like this one. And as always, please remember to do your own due diligence when investing and seek a financial advisor for professional advice. So what's going on today with the indexes? The Dow Jones had a significant drop in its stock price, dropping the stock price at almost 2% down on Thursday, yet rising back up on Friday. If we take a look at the S&P 500, it followed a similar pattern like the Dow, where the stock price almost dropping at 1%. Lastly, let's take a look at the Nasdaq. The Nasdaq took a huge hit, far worse than the other indexes, with its stock price dropping at almost 4%. So what's going on? Why is there a huge dip in the stock price at almost the same exact time? Well, the most probable reason is because of what the chairman of the Federal Reserve, Jerome Powell, stated on Thursday. Powell spoke on a Wall Street Journal virtual conference where he made significant comments that worried investors. Let's take a look at this CNBC article. He stated that he expects that the economy will reopen and hopefully pick up, but we will see inflation move up through base effects. He also stated that this could create some upward pressure on the prices. As we can see from this article, Powell says that inflation is likely to rise as the economy recovers, but he thinks it will only be temporary. Without some durable inflation and a return to full employment, the central bank would be unlikely to raise those interest rates. For a very long time, investors have believed that the huge surges we saw previously in 2020 were at a point where it was too high and that there was no market value that explained why it was so high. They termed that the market at the time was a bubble, so investors are worried that we're heading toward the explosion of the bubble.
Thanksgiving, I came on the show and I did a bit of a mea culpa, admitting that I had been too cautious since late June or early July. And, I came to realize that sentiment and flows were likely to carry equities higher into the end of the year and likely into the new year. On the 6th, just a couple of days ago, given what I'm seeing, especially in small caps, and you mentioned the Russell a moment ago, relative to both valuation as well as technicals, I really felt it was time to sort of say that 6 weeks of bullishness had run its course for me. To me right now, I think investors are looking to buy disruption, the likes of Moderna or the next Tesla, and really not paying any attention to valuation whatsoever. And to me, that's really, and I loathe to use the term, but that really is the definition of what makes for a bubble.
And Powell's comments on Thursday don't seem to dispute that idea. Even though Powell stated that the inflation would be temporary, the market still negatively reacted to the news. And in these types of situations, the market becomes very hypersensitive when any bad news or any bad predictions from high authority figures like Powell make grand statements. But even though Powell's statements are not all doom and gloom for the market, investors are worried about another huge issue, the rising bond yields. As the CNBC article states, the bond yields climbed as Powell spoke and as the market looked for more commentary on future policy. The rise in bond yields unnerved investors on Wednesday, causing the Nasdaq to tumble around 3.8%, with Tesla dropping 13% and Amazon shedding 4.1%. As we can also see from this article, the Fed has repeatedly stated that the short-term interest rates are going to be near zero and that they will continue to do monthly bond buying programs until they'll see a low unemployment rate and that the job recovery will be inclusive across income, gender, and racial lines. If you don't know what bonds and bond yields are, we'll go over that really quickly. Bonds are simply a loan given to a company or government by an investor. The investor will get money off of the interest of the loan. So in this scenario, the Fed is issuing bonds to fund new projects or ongoing expenses. The bond yields are the return to an investor from the bond's interest payments. So today, there was a big move up in bond yields after Powell's remarks on Thursday. As we can see from the chart, the 10-year yield surpasses last week's highs. So what does this mean? It means two things. One, it means that bond traders are betting that inflation will rise. And two, bond traders are betting that the economy will end up getting a lot stronger in the future. These worries directly affected the stock price, which is a huge reason why these indexes are going down. So what does this mean for us? Should we worry? Well, we have to notice that investors seem to be worrying about one huge issue: inflation. With the upcoming $1.9 trillion package to be signed into law and the calls for a $15 minimum wage, investors have a fear that the prices of goods and services in the country will rise, therefore decreasing the purchasing power that investors have. These sell-offs that we're seeing in the stock are indicating that investors want to increase their purchasing power by selling their shares. Although Powell states that we should not worry as long as there are measures put in place, it is important for us to keep an eye and be aware of how the market reacts to the news.
Businesses and people would need to believe that larger increases in prices would be repeated year after year, and we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely that effects like the ones I described would be one-time effects.
Yeah. Morgan Stanley, Jim says it's going to remain elevated through mid-year as inventories and supply chains remain challenged, which we talk about literally every day.
But as always, remember to do your own due diligence and to only invest what you're willing to risk. The market can be very unpredictable, and profits are never guaranteed. If you're looking to buy shares and need a brokerage, be sure to use our referral links in the description below for some free sign-on bonuses that can get added to your accounts. Good luck everyone with your holdings, and stay tuned on our channel for any news in the stock market. Thank you for watching today's video. Don't forget to subscribe and hit the notification bell to get notified when we release our next video. Please like and share for more videos similar to this one, and comment below with any questions that you may have so that we can address them in future videos. Thanks.